Welcome to the Daily MBA, where business wisdom is served fresh and fast, straight from one of the top MBA programs in the world. I'll give you summaries of my lectures and readings, as well as the most important insights gained from an MBA, so you can apply all of this knowledge in every business. Let's get started. In today's episode, I'm going to talk more about stocks. And I had previously mentioned stocks when I was explaining to you the perpetuity formulas, which were very simple. But in case you didn't watch my previous videos, I would suggest watching them just so you can understand better. But perpetuities are going to be cash flows that go on forever. And we had seen this compared to annuities because bonds were a type of annuity. You would know you would have a cash flow, but that one would only go through a specific amount of time. Now, when you're looking at perpetuities, this ones would go on for forever, let's say. And even though we said this sounds kind of weird, you can imagine that if I buy stock of Coca-Cola today, and if I'm planning on getting its dividends, it's not going to be just 2 quarters or 5 years. I could hold that stock until either it gets broke and it goes out of the market, or until either I die. So for financial terms, this is going to act as something that goes on forever. And that's why stocks, when we first saw them, we were doing some calculations with perpetuity to find the right price. But so this wasn't a very good method for accurately pricing a stock, because first, dividends are discretionary. So most of the companies today aren't even giving out as many dividends, or they can randomly stop, or we can't tie a company's value or fair price of the stock into its dividends, because Google, Amazon, all of these big tech giants are not giving dividends. Apple does, but that doesn't mean that in 5 years they'll continue giving dividends. So right now, things have changed and we can't assume that companies are going to give dividends. And then second, also this model would be very simple. So even though you are calculating with this, not all companies have growing dividends, for example, or it can assume that investors are only valuing the cash dividends. While I may have a share on Amazon, not because I like the dividends, but because I believe that companies bringing value into the world. So when we did this valuation, it's going to be most likely a wrong valuation. But anyway, this valuation would be done by taking dividends and dividing them by the discount rate, which in that time I didn't go into, but this would be specifically the company's discount rate, and the cost of equity discount rate. That's how we call it. And then minus the perpetual growth rate. But today we're going to start looking at more complex models to see how we can accurately value a stock. The first model is going to be one that is also relatively simple, so you can use. It's not just very accurate, but it's a good way to reflect the current market conditions. And this one is called the multiples valuation. And what this one wants to do is take the multiples from the market into creating a relative valuation. So let's say, for example, I want to buy a house. One of the ways I can know if the house is fairly priced is I can look what the house around it are costing, or on the same building, how much are those apartments costing. So I can usually compare, and from comparison, I can find a fair value. This is what multiples valuation is trying to do, and is going to use 2 measures that you've probably heard before. One of them is the PE ratio, which I already explained. The other one is EPS, which I also explained. PE ratio means price over earnings ratio, and EPS means earnings per share. And this ones, you will find them in any trading platform, Yahoo Finance, Google Finance. You can just type them in, Apple's PE ratio, Apple's EPS, and it will give it to you. So these ones are going to be important because you could take the industry average or the competitor's average PE ratio, and that you're going to multiply that PE ratio times your company, the one that you want to value, the EPS. So you take a benchmark of PE ratio and multiply it by the company's EPS, and that technically would give you a fair price of a stock. So it's very simple, right? And it's going to reflect the market conditions, how much everyone is valuing these types of companies. Caveat here would be who is really a good benchmark or competitor that you can compare this company with. Because, I don't know, let's say we imagine Amazon and Google. They're both competitors because they're both doing ads. So I want to compare the Amazon ads and Google ads part. But we're also forgetting that Amazon has a ginormous retail part on them, and they also have the cloud service. Google also offers cloud service, but then they also have their other things like YouTube, like Google Maps. So these companies wouldn't really be comparable. And so this is a hard thing in finding in today's world. If it's more of a normal industry, let's say not very tech related, but in the automobile industry or in the retail industry, maybe you'll be able to find similar comparisons. But this one's a bit problematic if, then again, you can't compare the peers or you're assuming the peers are also correctly valued by the market. What if everyone's overvalued? Then you wouldn't really get a fair price. You would only get an overvalued fair price according to that market. So, discounting dividends won't work. Comparing this one, multiples valuation may work, but it's not your best choice. So what should you do instead? This is going to be the model that people at Wall Street are still using. And the technical model for this, it's a DCF because it's discounted cash flow model. So what we were doing with the dividends was also this. Technically, we're discounting the dividends into a present value. But the one that we're going to focus on, it's the free cash flows discounting model. And the free cash flow of the firm, which is usually abbreviated as the FCFF, will give you better estimates than other cash measures. And this will also be discounted with a specific rate. So for discounting dividends, we were using cost of equity, which was what I told you. It's a measure of return, but only for the side of equity of the firm. If we were to mix equity plus debt, we would get like a big rate. And this one is called the weighted average cost of capital, but nobody calls it this very long name. Everyone will call it the WACC. So it's WACC. And this WACC is going to give you the rate at which you will discount all the free cash flows of the firm. And so the free cash flows of the firm are very easy, let's say, to calculate. You would just take EBITDA, which is revenues minus operating costs. And then from that, you would take away taxes. If it isn't calculated for you, it would just be EBITDA minus depreciation. And then you would multiply that by the tax rate. And then from that, you would also take away the CapEx, so capital expenditures. And lastly, you would take away, so subtract the change in the net working capital. And this means current assets minus current liabilities. After you add all of this, you would get the free cash flow of the firm. So it's just looking at financial statements. If you listen to all my accounting episodes, you'll be fine. You know how to read them. You just have to make this math and get the free cash flow of the firm. The thing is, how do you get all of this for all the years to come in a company? And that's going to be a little bit harder. But for now, we just have to know that this model is the standard one. So as soon as you get the free cash flows of the firm, then you would discount them with the WACC. I'm going to go into how do we get this in a moment. And this will give you the entire firm's present value. So now you only need to take away the debt because you don't care about debt. You're looking at the value of the equity now. And you would divide the equity by the amount of shares. So shares outstanding would be a good measure since those are going to be the ones in the market. if you would divide it by the amount of shares, that would give you the fair price per share. Sounds kind of easy, right? You have the free cash flows of the firm, discount them, then subtract that. We're not looking at that, and we divide it by the shares. So, magic, right? The thing is, first, how do you get the future cash flows? And this is not even going to be the hard thing. How do you get all of this discount rates, right? So, for this, I'm going to start with the easy part. How do you get the free cash flows of the firm for all the years to come? And this is going to be an accounting technique. Let's say it's not the most accurate because I don't work in Wall Street, so I'm just going to give you the one that I'm using. As soon as you estimate the revenue, that's going to be the key point for where you can estimate costs as a percentage of revenue. Then you can also estimate depreciation as a percentage of cost. You can start bringing it down based on the historical average. So this is the best that you can do when faced into an equity valuation like this, because you can't be extremely accurate. One way to predict revenues would be also by looking at previous growth and estimating it. There are many analysts doing this for most companies. They're estimating either how much it will be their perpetual growth of revenues, or also how much it's going to be revenues for the next 2 years or 3 years. All of the analysts at Wall Street are trying to do only this part, but I'm telling you that this part is going to be less stressful, let's say, for us, since we are not professionals in doing this. And we could just take values such as the ones presented in Capital IQ, for example, or other platforms when you can access financial data and you can take all of these estimates that other analysts are doing into your own model. Now, let's go to the second issue. How do we get the discount rate? And here, it's a Nobel Prize winning idea, so this is not as intuitive as you would think. And it's from a model called the CAPM, or the Capital Asset Pricing Model. Okay? So the CAPM is going to be a simple formula that's saying the cost of equity will equal the risk-free rate, that is the rate of any bond, because that's risk-free at the moment. And then you're going to multiply the beta of the firm, which I'm going to talk about in a second, times the market risk premium. So very simple. This model was created by William Sharpe. He already figured it all out for us. We don't have to worry too much about the CAPM, just about following it. And if you feel kind of lost, I'm going to put a link on the description of this video where I'm also going to be sharing all of these things that I'm showing you in notes, so you can understand them better. But so risk-free rate, I told you it's going to be the bond rate. Now, what is beta? Beta is going to be a measure of the sensibility to the market fluctuations. Maybe if you like stocks and you've been looking around Yahoo Finance or Google Finance or all of these other platforms that I recommend, you may look into any company that you want and you may see their beta. So for example, if we look at one of my favorite companies in the stock market, which is Marsh McLennan, they would have a low beta because they are in the risk industry, insurance industry, and so they have a 0.94 beta nowadays. What does this mean? If it was a beta of 1, it would mean they are moving exactly as the market is moving. They are moving a little bit less than the market is moving, so this takes away a bit of the volatility from you. But then, for example, there's another company that I've been following that's called Sea Limited. They do software development in Singapore, and their beta is 1.56. So what does this mean? They're moving even more extreme than the market. If the market grows, they grow even better. But if the market falls, they fall very hard. So the beta is going to give you a measure of the sensibility of a specific stock. calculating beta is a horrible, horrible equation. And also it's not needed because you have all of these companies that are already doing it for you for free, such as Yahoo Finance or even in Google Finance. So you can just look at the company that you want to calculate, you'll find their beta, and you're going to take that and multiply it by the market risk premium. In this, it's also going to be a more ambiguous concept, but I'll try to make the long story short. The market risk premium means that you're measuring how risky it is to be in the stock market. So we're taking that risk premium that a company has from the stock market and multiplying it by its beta. So as I told you, first company, Marsh McLennan, is going to be a smaller number because we're multiplying it by 0 point something. But then the other company still limited, it's 1.6 almost. So we're going to have lots of market risk in that company. The market risk premium, it's going to be always a number between 4% and 6%. And so how amateur analysts like me, and maybe you do it, it's that we would choose a number between 4% and 6%. So for now, we can use 5%. And what we're going to do is take that 5% market risk premium multiplied by the beta of the company. And then we're going to add that to the bond rate. So in this case, it's going to be the risk-free rate that's going on right now. Depends on which country you are, but you would add it to that. And once you have that, you would have the cost of equity. This is the most important invention from the CAPM. From the CAPM, you can get the cost of equity. So one, you could use that one for discounting all the dividends, which I told you wasn't very accurate, but you could do it. But then also with the cost of equity, you can already find the WACC, because the WACC is going to be also a simple equation. I'll post the photo so you can see it, but it's equity over that plus equity multiplied by cost of equity that you already have, and then plus that over that plus equity multiplied by 1 minus the tax rate times the that cost of debt. So this is going to give you the cost of the firm, let's say the WACC, how we refer to it, and now you can discount all the free cash flows. In my next episode, I'll continue talking about this because there's a lot more than we can learn from the CAPM and other models that are useful for this. So stay tuned and remember all of those concepts for our next episode. I'll see you next week.